Welcome to this explainer. Let's just jump right in. Today, we're demystifying the stock market. Look, even if you follow the financial news religiously, it is incredibly easy to get completely lost in the noise. So we're going to strip it all back to first principles. We all know the vibe, that absolute visual chaos on trading screens and financial networks. You've got flashing numbers, jagged charts looking like lightning bolts, and endless stacks of green and red candles. Honestly, it's a sensory overload, and it is perfectly designed to make you feel like every single microsecond is a life or death decision. But how does the whole thing actually work under the hood? What's really going on? Today, we are tossing out all that complicated finance jargon, and we're breaking the system down to its core, simple mechanism. All right, here is your ultimate anchor. A stock is simply a piece of ownership in a real, actual business. It is not just some random floating ticker symbol or a blip on an app. When you hit buy on a share, you are claiming a fractional stake in a living, breathing company. That's the reality. So why on earth would a successful founder just sell pieces of their company to strangers? Well, in a word, growth. To expand operations, build cutting-edge products, or hire thousands of employees, you need massive amounts of capital. Fun fact, the Dutch East India Company was the first to actually do this all the way back in 1602. Basically, instead of taking on crushing, heavy bank debt, a company goes public through an IPO, an initial public offering, trading equity for the cash they desperately need to scale. Okay, but what's in it for us? Why do investors buy in? Mainly, it's two things. First, if that business grows, a $50 share might become $100. Boom, that is your capital gain. Second, some highly profitable companies will literally just hand you a portion of their profits directly, which are called dividends. You get paid simply for holding the asset. Pretty cool, right? Which brings us to a really fascinating puzzle. If a share is just a piece of a business, why does its value bounce around every single second of the trading day? It all boils down to three things: supply, demand, and expectations. Sure, basic economics tells us that if everyone wants to buy, prices go up, and if everyone is rushing for the exits, prices crash. But expectations, that is the real engine here. The market is a forward-looking machine. It is constantly pricing in what investors think is going to happen tomorrow, not just what's happening today. So what actually shifts that supply and demand day to day? It is this wild, volatile mix of cold hard math and raw human psychology. You have company earnings and big macroeconomic factors like interest rates setting the baseline. But human emotion? Man, raw fear during a global crisis or extreme hype around the latest tech trend, that is what usually drives those massive, dramatic swings. And remember, this massive tug of war is happening on a global scale. We aren't just talking about individual investors trading from their couches. You've got multi-billion-dollar pension funds, massive banks, and nowadays, lightning-fast algorithmic trading systems. These computers are executing thousands of orders before a human brain can even process a thought. Now, all of this chaotic action happens on a stock exchange. That's the centralized marketplace where buyers and sellers connect. We used to picture a bunch of guys in suits yelling over each other on the floor of the New York Stock Exchange. But today, it is an almost entirely digital ecosystem running in fractions of a millisecond. But hey, we need a reality check here. There is an undeniable truth to this system. The market absolutely does not move upward in a straight line forever. Things like economic uncertainty, recessions, and global shockwaves breed real panic. That leads to aggressive sell-offs, market corrections, and yes, crashes. It's definitely uncomfortable, but it is an entirely normal feature of the market cycle. However, if you look at the historical data, a really crucial counter-narrative emerges. Over long time horizons, markets have shown this incredible, almost stubborn capacity to recover and grow. The smart money doesn't sit around obsessing over the daily dips. They rely on the historical resilience of the broader economy over decades. Embracing that takes a huge mindset shift. It means actively moving away from emotional rookie behaviors, like buying into internet hype or panic selling everything the moment the market drops. Instead, you focus on disciplined habits. You deeply understand the businesses you own, you manage your risk, and you just let compound growth do its thing, patiently, over time. So let's tie this whole thing together.
The stock market is essentially a giant bridge. It connects ambitious businesses that need capital to innovate with everyday investors looking for long-term growth. When you just tune out all that algorithmic noise and flashing red lights, it really remains the greatest wealth creation engine ever built for the patient investor.
Ultimately, the most empowering mindset shift you can make is this. You stop seeing stocks as random flashing numbers, and you start seeing them as real companies. Once you embrace that, all the chaos finally starts to make sense. So I'll leave you with this question to think about. What is one company that you gladly give your money to every single day that you haven't even bothered to research yet? Think about it. Thanks for joining me for this explainer.